Everybody's panicking right now, and if you've been anywhere near financial Twitter or YouTube this week, you already know exactly what I'm talking about. The software sector just got absolutely torched, and the narrative being pushed from every corner of the internet is that artificial intelligence is coming for every single software business model on the planet, and that you should be running for the exits as fast as your feet can carry you. But before you do that, before you hit the sell button on anything and everything that has the word software or technology attached to it, I want you to stick around for the next 15 minutes because I'm going to walk you through why this sell off is largely manufactured fear, why the data is actually screaming buy rather than sell, and why one company in particular, Tesla, is sitting in a completely different category that most people rushing for the X's are completely and totally missing. Now, before we dive in, the only thing I ask in return for all the work that goes into making a video like this is that you hit that like button and don't forget to subscribe. Every time you do that, YouTube pushes this video out to more people, which helps us prepare more people for what's happening. And if you want access to my best trade of the day based off a combination of market experience and algorithmic screeners that I use, plus a daily live streams on market analysis that cover any questions you ask in the community, you can try my Discord, the Stocks Community, for just $25 for 7 days at stockscommunity.com. And if you're looking for a free resource, head over to free.stockscommunity.com, where you'll be able to sign up for my free newsletter and get market updates that I can't share here on YouTube due to the sensitive nature of the content, some of which involves government figures and their stock portfolios that YouTube can sometimes restrict on its platform. The link's in the description below. As always, this is not financial advice. Do your own research. So let's start with what actually happened this week, because the story being told in the headlines and the story being told by the actual data are two very different things. Anthropic, the AI company, released a new automation tool that's been described by some analysts as a DeepSeek moment, a reference to the Chinese AI model that spooked markets roughly a year ago. Anthropic's tools started with something called Claude Code, which helped software developers write and deploy code faster in a more automated way than had ever been possible before. That then evolved into broader productivity tools across a whole range of business functions. And then the latest and most disruptive twist is that they released a specific automation tool targeting legal services. And that right there is what lit the fuse this week. Suddenly, investors started asking a very uncomfortable question, which is whether a tool like this makes entire categories of high-value professional work obsolete almost overnight. And the fear spread fast because if legal services can be disrupted this quickly, then what exactly is safe? The advertising giants Publicis and Omnicom got absolutely hammered too, despite Publicis actually reporting genuinely good earnings results, which tells you everything you need to know about the nature of this selling. Because when a company beats earnings and the stock still falls hard, you're not watching irrational markets at work. You're watching panic. This was fear spreading like a virus from one sector to the next, with investors hitting sell first and asking questions later. And that kind of indiscriminate selling is exactly where the greatest opportunities tend to hide if you know where to look and you have the stomach to act when everyone else is running away. Now, here's where I want to slow down and be very precise about something, because there's a real and important distinction between companies that should genuinely be worried about what Anthropic just released and companies that are simply getting caught in the crossfire for no good reason at all. If you're running a business that essentially sits between a user and a pile of data, and your entire value proposition is just organizing and presenting that data in a slightly more convenient way than the raw source, then yes, you should be concerned, because an AI tool can absolutely do that faster and cheaper and at a scale that no human workforce can match. But if you're a company with genuine proprietary data, real-world physical infrastructure, hardware assets, network effects that took years to build, and a technology moat that cannot be replicated with a software update, then the Anthropic news this week is not a threat to your business model. And it might actually be a tailwind, and that distinction is absolutely critical to understanding what you should be doing with your money right now. Let me give you the data, because the data is where this story gets really interesting and really compelling. A quantitative money flow analyst looked at the outflow data for technology stocks during this sell-off and found that we just hit the 99.6 percentile of selling pressure going all the way back to 2013. That means that at every single trading day over more than a decade, only 13 days saw more forced selling in technology stocks than what we just witnessed this past week. Let that sink in for a moment. This was not normal profit taking. This was not healthy rotation. This was an extreme, historically rare forced liquidation event. And when you understand what exactly caused it, the opportunity becomes very clear. What happened is that a large number of hedge funds and institutional players were simultaneously long on technology stocks, long on semiconductors, and also long on crypto. And when crypto started falling and those leveraged positions started moving against them, their prime brokers did what prime brokers do, which is tap them on the shoulder and tell them to reduce their risk immediately or face forced liquidation. And when you get that call, you do not get to be selective about what you sell. You sell whatever has profits in it. And for a lot of these funds, the profits were sitting in software stocks and chip makers that had been on an incredible run. So they dumped them fast and hard. And the financial media looked at all that selling and needed a story to explain it. And the Anthropic legal tool announcement was sitting right there as a perfectly convenient narrative. But here's the thing about narratives in financial markets. They're almost always assigned after the fact to price action that was actually caused by something else entirely. The selling caused the narrative, not the other way around. And that means the narrative will fade when the selling pressure fades. And history tells us very clearly what happens next. When you look at the IGV, which is the big software and technology ETF that holds names like Microsoft, Oracle, and Palantir, this past week saw the kind of oversold extreme that has only occurred 6 times since 2001. And here's what the data shows happened after each of those 6 instances without a single exception. 1 week later, the average return was slightly negative, down about 1.8%, because these things do not reverse instantly, and everyone telling you to expect an immediate snapback is not being straight with you. 1 month later, though, the average return was up 12.1%. And then 3 months later and 6 months later, the software ETF was higher every single time with 0 exceptions, averaging gains of well over 30%. 100% hit rate, over 30% average gain, and we're sitting right at one of those historically rare entry points right now, which is why some very smart investors were out there buying the software ETF for their kids this week while everyone else was panic selling it. And if that data alone is not enough to make you think twice about the narrative being pushed this week, there's another study worth understanding that looked at what happens when you get extreme rotation out of technology stocks and into energy stocks simultaneously, which is exactly what we saw this week with money flooding into energy and draining out of tech at the same time. Historically, there have only been a handful of times where this rotation has been as extreme as what we just witnessed. And the forward return data from those prior instances tells a very consistent story. In the short term, over about 1 month, technology tends to underperform, which makes sense because the rotation momentum takes time to reverse. But when you go out to 3 months, 6 months, 12 months, and 24 months, the data says you need to be in technology stocks, not energy stocks. On a 12-month basis, after these extreme rotation events, the technology sector ETF was up 85% of the time, with average gains of 28%. Energy, by contrast, only up 55% of the time with average gains of just 10%. So the people rotating in energy right now out of tech are historically making a trade that looks smart for about 30 days and then looks very painful for the following year. And by the way, that semiconductor shortage that everyone was talking about before this week's chaos did not go away because Anthropic released a legal automation tool. There's still a massive shortage in SRAM and DRAM memory chips. Analysts are saying it could last years. AI applications need more chips, not fewer chips. So the idea that the chip sector sold off because of a disruption narrative makes no fundamental sense whatsoever. And that is further confirmation that what we witnessed was forced liquidation, not a rational repricing of the technology sector based on new information. Let's talk about the specific stocks that are screaming opportunities in this environment, because the data tells you to buy the sector, but you still want to be in the highest quality names when you're stepping into a sell-off of this magnitude. The first name worth looking at seriously is Intuit. And if you're not familiar with Intuit, they make TurboTax for tax preparation and QuickBooks for small business accounting. And those are products that tens of millions of people rely on every single year, whether the economy is good or bad, whether AI is disrupting legal services or not, because taxes do not go away and small businesses still need to manage their books. Stock was trading at near its peak last July. It's been cut nearly in half, sitting close to a forward price to earnings ratio around 18 times, which for a company of this quality with a profit margin of over 20% and strong sales and earnings growth on both a 1-year and 3-year basis is genuinely cheap. It's a $120 billion company that has every reason to be a $200 billion company before it ever becomes an $80 billion company. And it's on sale right now purely because of the macro selling pressure I just described, not because anything is wrong with the business. The second name is Oracle, and Oracle you need to think about in the context of the Stargate initiative and everything that's happening at the intersection of AI infrastructure and cloud compute. Oracle was trading at somewhere around September's levels all the way down to about half that, which is a massive drawdown for a company that's sitting right at the center of the AI infrastructure build out. And when you think about what Stargate means, when you think about the relationship between Oracle and OpenAI, when you think about the fact that enterprise cloud demand is not going away regardless of what automation tools Anthropic releases, Oracle looks like a company that got punished by the same macro deleveraging that hit everything else. And the opportunity that creates is real. And then there's Microsoft, which is the most obvious and in some ways most compelling name of all three, because Microsoft is not just a software company in the traditional sense that might face disruption from AI. Microsoft is an AI company. They have the deepest partnership with OpenAI of anyone in the industry. They're embedding AI capabilities across every single product in their portfolio, from Office to Azure to GitHub. Azure is their cloud computing platform, and it's been their largest revenue growth engine for several years running, growing fast and taking market share. So the stock last October levels, it's fallen about 15% from there, which looks absurd when you look at the fundamentals. 36% profit margin, low debt to equity, and strong earnings growth. And the point about Microsoft that really needs to be made clearly is that if AI is truly going to disrupt and replace traditional software workflows, Microsoft is one of the companies that's going to be doing the disrupting, not one of the companies getting disrupted. They're not sitting on the wrong side of this wave. They built the relationship with the company that's arguably at the frontier of it. So the narrative that OpenAI, or AI is coming for software and therefore you should sell Microsoft is almost perfectly backwards. Now, let's get to Tesla, because this is where I think the most important and most misunderstood opportunity sits right now. And it requires understanding why Tesla is in a fundamentally different category from every other company we've discussed so far. When Anthropic releases a legal automation tool and the market sells off software stocks, the fear is that AI will replace the value that those software companies provide. And for some of them, that fear has merit, but Tesla's not a company whose value proposition is organizing and presenting information in a user-friendly interface. Tesla is a company that is building the physical world in which AI operates. And there's a crucial difference between those two things that the market is completely failing to appreciate right now. Let me tell you what happened at Giga Texas just in the past couple of weeks, because it's generally historic and it got almost no mainstream financial coverage because everyone was too busy talking about the Anthropic sell-off. Tesla rolled the very first production Cybercab off the production line. Not a prototype, not a hand-built unit, a vehicle that came off an actual production line with all production hardware, production tooling, production fixtures, and production operators. Hundreds of Tesla workers gathered around it and celebrated, and Elon Musk posted congratulations to the team. Now, it's important to understand what this means and what it does not mean. So Let me be precise. This does not mean that volume production of the Cybercab has begun. What it means is that all of the production stations in the factory have been stood up. All the supplier parts are coming in off production tooling rather than prototype tooling. And the entire assembly process has been run from start to finish on a real production line for the first time. In manufacturing terms, this is called a first off production unit, and it is the critical connective tissue between where Tesla is today and the start of production milestone that's targeted for April. The typical process from here is that Tesla will tear this first unit apart, check every weld, every bond, every fit and finish tolerance, identify anything that needs to be adjusted, and then begin building more units at a slow but increasing rate. Think roughly one every other day in February, stepping up through March, reaching true start of production in April, where hundreds of units per month begin flowing, scaling into the thousands per month by the end of Q2, and potentially reaching 5,000 to 10,000 units per month in Q3. And here's a detail that should stop you in your tracks if you've been following this story casually. Elon Musk confirmed this week in response to a direct question on social media that Tesla plans to sell a Cybercab to an actual paying Tesla customer for $30,000 or less before the end of 2026. Not lease it, not put it in a fleet, sell it to a customer. A vehicle with no steering wheel, no pedals. It's an extraordinary statement that has enormous implications. It means Elon's confident the software will be where it needs to be. It means he believes the regulatory approvals will come through in enough jurisdictions to enable customer sales. And it means the production ramp will be sufficient to have units available for customers while also building out the robotaxi fleet in Austin and beyond. For context, a YouTube creator named Marcus Brownlee made a public bet in October 2024 saying there's absolutely no way Tesla sells a Cybercab to a customer for $30,000 or less before 2027, and that if they do, he will shave his head on camera. Elon responded to that threat directly this week by saying it's going to happen. Now, you can choose to believe Elon or not, and his timelines have famously slipped before, but the fact that the first production unit just rolled off the line in mid-February, well ahead of when most observers expected to see it, suggests that this particular program is tracking well. And let's talk about what the Cybercab actually is, because I think most people have a surface level understanding of it without appreciating the depth of what Tesla's attempting with this vehicle. Cybercab uses what Tesla calls the unbox production process, which is a radical redesign of how automobiles are manufactured that's never been done at this scale before. Traditional car manufacturing involves assembling a vehicle from the inside out, which creates enormous complexity and cost. The unbox process essentially builds the top and bottom of the vehicle separately and then combines them, dramatically simplifying the assembly process and enabling what Elon describes as 5 times higher production rates than conventional manufacturing once the system is fully ramped. It has no steering wheel, no pedals, frameless windows, a completely new door opening mechanism with scissor-style doors, wireless charging capability, and it's designed from the ground up to operate autonomously, not as an afterthought retrofit the way that most autonomous vehicle programs work. Jeff Osborne, who has deep manufacturing expertise, described it this way. This is a vehicle where the simplification of the end product, fewer parts, cleaner design, has actually created enormous new complexity in the manufacturing process because so many elements of it are being done for the first time at scale. New door mechanisms, new bonding processes, new electrical architectures, new production methods. Every ramp has a list of roughly 10 killer issues that need to be worked through, and Tesla will need to work through all of them between now and April. But the fact that the first production unit rolled off the line this week means they are on track to do exactly that. And here's what makes the Cybercab story so different from a software company worrying about Anthropic. The moat around this business is not an algorithm. The moat is a factory, a decade of real-world autonomous driving data, a global supercharger network that no competitor has anything close to, a service infrastructure that's already built out across hundreds of locations, and a software stack that's been learning from millions of vehicles driving billions of miles in the real world. You cannot replace that with a better prompt. You cannot disrupt that with a legal automation tool. And The autonomous driving numbers out of Austin are genuinely impressive even in this very early stage. The miles per intervention, meaning the number of miles the robotaxi drives between any kind of human intervention, doubled from around 200,000 miles in January to around 400,000 miles in February. And some analysts tracking the data closely are predicting that the Tesla robotaxi in Austin will fully surpass human driver safety by the end of the first quarter of this year. Now, there are real challenges that need to be acknowledged, honestly, because this is not a story where everything is perfect. The Austin robotaxi service currently has availability issues with roughly 50% of ride requests getting a high demand message and no car available. The wait times are averaging around 15 minutes when a car is available, which is not competitive with Uber or Lyft. The fleet is still very small, with estimates suggesting only around 45 actively deployed vehicles in Austin at any given time, and there have been 14 reported incidents in the Austin program, though when you look at those incidents carefully, 4 of them were not Tesla's fault at all. A bunch happened at 1 or 2 miles per hour in parking lots, and the most serious ones involve details that are still redacted, making it impossible to assess them properly. None of the 14 incidents involved airbag deployments, none required towing, and the highest injury severity alleged across all of them is property damage. So the safety record, while imperfect, is tracking in a direction that serious analysts believe will surpass human drivers within months. But the scaling patience required here is real, and anyone telling you that the robotaxi network is going to go from 45 vehicles in Austin to thousands of vehicles in multiple cities within the next few months is probably going to be disappointed. This is going to be a slow, methodical, safety-first ramp, and that is actually exactly what it should be, because one serious accident that makes headlines could set the entire program back by years. The infrastructure build-out is happening in parallel, with Tesla hiring for roles in insurance operations, rental processes, regulatory compliance, and fleet management, all of which are the unglamorous but absolutely essential plumbing of a robotaxi business at scale. And then there's Optimus, which deserves at least a mention in any serious conversation about Tesla's long-term value, because it is part of the same fundamental story. Tesla's building humanoid robots in parallel with the Cybercab program, using the same AI architecture that powers full self-driving, the same manufacturing infrastructure, and the same vertical integration approach that lets them move faster and cheaper than any competitor. Gen 3 of Optimus is expected to be unveiled in the first quarter of 2026, which is right now, with upgraded hands, better balance, and more capable motor control. The plan is to deploy Optimus first in Tesla's own factories, where it can gather efficiency and safety data in a controlled environment, and then expand into external use cases from there. Elon has stated a target of 1 million units per year from the Fremont factory, and potentially 10 million units per year from a massive new Giga Texas facility dedicated to Optimus production. Those numbers sound almost impossibly ambitious, but so did a lot of things Tesla said 10 years ago that turned out to be real. And the broader macro backdrop for all this is more supportive than the panic in the markets this week would suggest. Bond yields have dropped significantly in just the past few days, falling from around 4.25% down to 4.05%, which feeds directly into mortgage rates and consumer borrowing costs. True inflation, measured by companies that collect real-time data directly from retailers and landlords, rather than using the government's lagging methodology, is running at under 1%. The Bureau of Labor Statistics recently admitted they overcounted jobs in 2025 by roughly 900,000, which raises serious questions about how accurately they're measuring anything else, including inflation. And the direction of all the real-time data suggests the Fed is going to have to cut rates, with the odds of cuts in both March and April having increased in recent days. A falling rate environment is historically one of the best possible environments for growth assets, and technology stocks in particular. So the macro wind that's been a headwind for much of the past 2 years is now shifting direction. And look, the deeper point here is one that gets lost in all the noise of a week like this one. Throughout all of human history, every major wave of technological disruption has generated the same fear, which is that the new technology is going to destroy the old economy and leave workers and investors devastated. When factories came and replaced hand assembly, people were terrified. When the automobile replaced the horse and buggy, people were terrified. When the internet arrived, people were terrified. And in every single case, the disruption was real. Some companies did not survive it, but the overall economy did not collapse. It expanded, creating new industries, new jobs, and new opportunities that nobody could have predicted from the vantage point of the disruption. The people who got wealthy in those transitions were not the ones who ran away from the disruption. They were the ones who identified which companies were on the right side of it, bought them when everyone else was scared, and held on long enough to be right. And that's exactly the situation we're in right now. Anthropic releasing a legal automation tool is real disruption for certain categories of professional service companies, but it's not the end of software. It's not the end of technology. It's absolutely not bad news for a company like Tesla, which is building the physical infrastructure of the AI-powered world that Anthropic and every other AI company needs to operate in. The semiconductor shortage did not go away this week. AI still needs more chips, not fewer. The demand for cloud computing is not shrinking because of a legal automation tool. And the need for autonomous transportation infrastructure is, if anything, growing faster than anyone expected. So here's the bottom line. We just witnessed one of the most extreme forced selling events in technology stocks in over a decade, driven by crypto deleveraging and hedge fund margin calls with a convenient narrative attached to it after the fact. The historical data from similar extreme sell-offs shows gains of over 30% on average in the following 3 to 6 months, with a perfect hit rate. The street stocks that look most compelling in this environment are Intuit at roughly half its peak price with an 18 forward earnings multiple and a 20% profit margin. Oracle sitting right at the center of the AI infrastructure build-out after a massive drawdown. And Microsoft, which is not a victim of AI disruption, but one of the primary architects of AI with a 36% profit margin and Azure growing fast. And sitting above all of them in a completely different category with a completely different kind of moat is Tesla, which just rolled the first production Cybercab off the line this week. Confirmed plans to sell one to a customer for under $30,000 this year, is tracking autonomous driving improvement at a rate that could surpass human safety within weeks, and is building out the physical infrastructure of the AI economy in a way that no software tool can disrupt or replace. What did I miss here, and what would you push back on? Let me know in the comments. And if you want access to my best trade of the day based off a combination of market experience and algorithmic screeners that I use, plus daily 15-minute lives on market analysis, head over to stockscommunity.com, try my Discord for just $25 for 7 days. Plus, if you want market updates I can't share on YouTube, sign up at free.stockscommunity.com. If you found this valuable, smash that like button, subscribe to the channel, and share this with somebody who needs to hear it. The fear this week was real. The panic was understandable. But the data says the opportunity is right in front of you, and the people who act on it while everyone else is still scared are the ones who tend to look very smart about 12 months from now.